The topic for this video is Module 3, Inputs and Tools, Chapter 7, Financial Statements for the CFA Institute Investment Foundations Program. Okay, this video is for Chapter 7, Financial Statements, which is basically accounting. And there are 10 learning outcome statements. And you can see in the learning ecosystem there are 70 questions, which is a little bit more than we've seen previously. But don't worry, I would say in general, on average, those questions are not all that difficult. And if you give this, if you have no background to accounting whatsoever, do not worry. This is a very nice introductory chapter to financial statements. Pretty easy to understand. The questions are pretty easy to understand. It's nicely laid out. So if you have no background in accounting, not to worry. You'll learn something from this chapter fairly easily. The 10 learning outcome statements for this chapter are: A, describe the roles of standard setters, regulators, and auditors in financial reporting. B, describe information provided by the balance sheet. C, compare types of assets, liabilities, and equity. D, describe information provided by the income statement. E, distinguish between profit and net cash flow. F, describe information provided by the cash flow statement. G, identify and compare cash flow classifications of operating, investing, and financing activities. H, explain links between the income statement, balance sheet, and cash flow statement. I, explain the usefulness of ratio analysis for financial statements. And finally, J, identify and interpret ratios used to analyze a company's liquidity, profitability, financing, shareholder return, and shareholder value. Learning outcome statement A is describe the roles of standard setters, regulators, and auditors in financial reporting. So the first thing that we're going to look at are the standard setters. And standards for financial reporting are typically set at the national or international level by private sector accounting standard setting bodies. So the two standards that we need to be familiar with is number one, IFRS, which is International Financial Reporting Standards, and number two, US GAAP, which is US Generally Accepted Accounting Principles. Starting with IFRS, International Financial Reporting Standards, as of 2013, most countries require or allow companies to produce financial reports using IFRS, okay? In the United States, US-based publicly traded companies must report using US GAAP, but non-US based companies may report using IFRS. When standards allow some choice, the accounting method that a company chooses affects the earnings reported in the company's financial statements, okay? And regulators, this is the role of the regulators. Regulators support financial reporting standards by recognizing, adopting, and enforcing them, and by implementing and enforcing rules that complement them. That's a very important thing to understand, is that regulators don't set the standards, they support the financial reporting standards. The key words are recognizing, adopting, enforcing them, and implementing and enforcing rules that complement them. So some keywords that you would want to put onto a flashcard. Now in this new slide, we're looking at the role of auditors in financial reporting. So auditors, before they can be published, the financial statements must first be reviewed by independent accountants called auditors. Okay, that's called an external audit. And here we can see that on the left-hand side, an unqualified or clean opinion means that the financial statements are prepared in accordance with the applicable accounting standards. So you have to pick up on the word unqualified, or clean means that their statements are prepared in accordance. An adverse opinion, however, indicates that the financial statements do not comply with the accounting standards and therefore do not provide a fair representation of the company's performance. So it'd be very bad if we saw a set of financial statements where the letter from the auditors stated an adverse opinion. Okay, so what we're looking at is we're looking for unqualified or clean opinion. So note that a clean audit report does not always imply a financially sound company, but it only verifies that the financial statements were created and presented correctly. It is not a judgment on the company's performance, but on how well it accounted for its performance. So that's a key point to understand about the audit statements. Learning outcome statement B is describe information provided by the balance sheet. But before we do that, we're just going to give a bigger overview with regards to financial information. So a company is required to keep accounting records and to produce a number of financial reports, which include the following. So the first is the balance sheet, and that's what we're going to be looking at over the next few slides. A couple of things to note is, first of all, the balance sheet can also be called the statement of financial position or statement of financial condition. So you have to understand that there's different terms meaning the same thing. The next thing, what does the balance sheet show us? It shows us what the company owns, which are assets, and how it is financed. So assets are financed either through liabilities, which are loans, need to be paid back, or through equity, which is what the shareholders own. Okay. Moving on to the income statement. Again, the income statement can also be called the statement of profit and loss, profit and loss statement, or statement of operations. So again, different terms meaning the same thing basically on the income statement. And the income statement identifies the profit or loss generated by the company during the period covered by the financial statements. So the financial statements could be for 1 month. You could be looking at a quarterly statement, half year, or the full year financial statements. The income statement is showing the profit or loss generated during that period being reported. Okay. So moving on then to the cash flow statement shows the cash received and spent during the period. And again, it's split up into 3 categories is an important thing to understand. The cash flow statement is broken up to operating cash flows, investing cash flows, and financing cash flows. Okay. Now, don't forget, notes to the financial statements are also a requirement. So when we're looking at the balance sheet or the income statement, you'll see if we look at an annual report, where do we find financial information? If it's for a publicly traded company, we can track down the annual report. They're usually all online now. And you'll see, again, different terminology, whether it's IFRS or US GAAP. But in general, we'll find the income statement, balance sheet, cash flow, and the notes to the financial statement. So on the balance sheet, there'll be like a 1 and a 2 and a 3, and you go back and you'll read the notes and it'll give you further information. Okay. One thing that it notes in the chapter that could be important, it could be tested, is that other reports may be required. So for example, in the United Kingdom, there's a director and auditor report that's required. And in the US, there's a 10K report that is filed with the Securities and Exchange Commission annually. And that's a other report that may be required. But the basic financial statements, balance sheet, income statement, cash flow, and notes to the financial statement. And now we'll be moving on and describing more information that is provided by the balance sheet. So now we're going to look at a little bit more detail about information provided by the balance sheet. So a couple of important points that we need to pick up on. Number one, the balance sheet is also called the statement of financial position or statement of financial condition. The second thing to note is that the balance sheet is at a specific point in time. So, for example, as at December 31st, 2018. When we look later on at the income statement covers a period of time. But for a balance sheet, it's as at that date. And that may be the end of the fiscal year, the end of the quarter. And what is the balance sheet showing? Essentially, it's showing the resources that the company controls, which are the assets. That's what the company owns. And it's also showing the liabilities, which is what the company owes, its obligations to lenders and other creditors, liabilities or debt. And it's showing the owner-supplied capital, which also known as shareholders' equity or stockholders' equity or owner's equity, different terms meaning the same thing. And so as you can see here, the accounting equation that we need to be familiar with is assets equals liabilities plus equity. So if I have an asset, it has to be financed either through a liability, which is an obligation to a lender, or it's from owner-supplied capital. Okay. Now you can see that some of the questions can be based on some algebraic rearranging, And we can see here that if we equity equals assets minus liabilities. Okay, so just by doing a little bit of algebraic rearranging, we can change the equation and identify that equity equals assets minus liabilities. So sometimes you'll get a multiple choice question, and again, it's an English test, subject accounting, and it'll be giving you, you'll have to pick out the right formula. And my advice is always don't try to do it all in your head. Just quickly write it out. Assets equals liabilities. Equity equals assets minus liabilities. And then finally, liabilities could even equal assets minus equity. And then line up the solutions to the question very carefully and match it up. Don't try to always do it in your head. Okay, that's a little exam tip. So continuing with the balance sheet and a little bit more on the accounting equation. So recall, assets equals liabilities plus equity. Assets are what the company owns, and liabilities are what the company owes. So if I do a little bit of algebraic rearranging, assets minus liabilities equals equity, and that's what we're looking at a little bit more detail on this slide. What is that telling us? If I sold off all my assets and paid back all my creditors, what is left over would be mine, and that belongs to the owners. So equity reflects the residual value of the company's shares. Okay, I put that in bold and green. That's the keywords to pick up on. Equity equals the residual value. What does the residual value means? It's if we sell everything we own and pay off everything we owe, what's left over, that residual value belongs to the owners. So this value is generally not the same as the company's current market value, which is the value that the market believes the company is worth, or how much investors are willing to pay to own the shares of the company. Okay, so again, just a very quick thing. We're looking at assets equals liabilities plus equity. So assets minus liabilities equals equity. What that is talking about is we can have a book value for that equity based on the balance sheet financial statement. But if we look at the market value of the equity, we're going to get a different value because we're going to be looking at the number of shares outstanding times the market value, and that's going to give us the market value of the equity, okay, which is going to be different than the book value of the equity. So the next thing that we're going to look at is reported values on the balance sheet. So recall the accounting equation, assets equals liabilities plus equity. So when we're looking at some assets and indeed some liabilities on the balance sheet, they're based on what it originally cost. So they're held at historical cost or historical value. And you can see the implication of that. If I choose land, for example, land is an asset. There may be a company that bought some land many years ago, and it's sitting on the balance sheet at a historical cost. But if that land could be sold today, the market value may be much higher than that historical cost. So therefore, we sometimes look at the issue of fair values of assets. What's the fair value for the asset? And it's basically based on what it could be sold for today. Okay, so so then what makes up the book value on the balance sheet when we're looking at it? So the value of many of a company's assets are reported at historical cost, which is the actual cost of acquiring the asset minus any cost expense to date. So again, land we never depreciate, but if I look at other assets such as trucks, I buy a truck back in 2013 and now it's 2018. You have to understand that it's not on the balance sheet at that historical cost. I've had some depreciation expense over the years. So the cost of the truck is being expensed over a number of years through a depreciation expense, which is a non-cash item. Don't worry, that's going a little bit above and beyond the nature of the chapter, but I just want to point out that if we look at a truck, it's not sitting on the balance sheet at historical cost. It's going to be historical cost minus accumulated depreciation, which is an expense over time. Okay, but an alternative is to report the value of an asset at its fair value, which reflects the amount the asset could be sold for in a transaction between willing and unrelated parties, called an arm's length transaction. Okay, so fair value accounting is not required except for a few assets, such as some financial instruments. Most companies choose to report assets where allowed at historical cost. The balance sheet rarely shows the current market value of the assets or the company itself because most of the assets are reported at their historical cost rather than fair market value. So the balance sheet values, again, are commonly known as the book values of the company's assets, liabilities, and equity. Okay, now we're looking at the balance sheet that is presented in the text, the curriculum, as Exhibit 1. And it's ABC Company Statement of Financial Position. So they're not using the balance sheet, they're using the Statement of Financial Position. And the first thing to point out, that is as of December 31st, and it's showing 2 years in the columns, 20X1 and 20X2. So you can see in this case, the most recent year is in the left-hand column, but sometimes you see it presented where the most recent period is in the right-hand column, okay? Another thing to note is that the statement is in millions. So if we look here at cash in 20X2, that is 25 million, okay? So recalling the accounting equation, remember assets equals liabilities plus equity. So here we can see total assets equals 496, total liabilities is 296, and total owner's equity is 200. So 200 plus 296, liabilities plus owner's equity equals 496. Total assets equals liabilities plus equity. So for 20X1, we can see total assets 496, total liabilities 296, owner's equity 200. As we move to 20X2, a couple of other things to point out on the balance sheet. First of all, we can see that the total assets is split between two categories. The first category is current assets, and the next category is non-current assets. So what makes up the current assets? The current assets are made up of cash, accounts receivable, inventory, and other current assets. That could be some sort of note collectible, okay, in the short term. And the general definition for current assets are cash or assets that can be converted to cash in 1 year or the normal operating cycle of the company, okay? So we can see here current assets, and then the non-current assets are made up of gross property, plant, and equipment. So that is the historical cost of the property, plant, and equipment minus accumulated depreciation. There is depreciation on plant and equipment, as we briefly talked about. We're not going to get into the nitty-gritty in this video. Nevertheless, depreciation expense is the expense of owning an asset over a period over its useful life, okay? And each year that depreciation expense accumulates onto the balance sheet as accumulated depreciation, and we get the book value of the assets, okay? Assets are total assets split between current assets, non-current assets, current assets, cash, accounts receivable, inventories, cash or assets that can be converted to cash in 1 year or operating cycle, non-current assets, gross property, plant, and equipment minus accumulated depreciation. And here we've got something called intangible assets. These are assets that we can't touch or feel. And so an example would be a patent. A patent is an asset. It's a resource controlled by the company that has a value, but we call it an intangible asset. There's other examples such as goodwill, okay? So we can see 20X2, current assets 165 plus non-current assets 400, total assets 565, and the total assets equals liabilities plus equity of 565 in 2000 and X2, okay? Moving on to the liabilities, you can see similarly to the assets, the liabilities are split between current liabilities and non-current liabilities. The current liabilities are things that we need to pay within 1 year or the normal operating cycle of the company. And you can see the list here are accounts payable. So these are things that I owe to someone. It's an obligation that I need to pay. Accrued liabilities, that could be, for example, wages payable. I've had people working for 2 weeks, but it's not yet check day. So that's an accrued liability. And we can see here a current portion of long-term debt. Well, let's start with what is a long-term liability. Long-term liability is something that will be paid back longer than a year, for example, so long-term debt. But there might be part of the payment, if it's a 10-year loan, well, each year I have to make payment on the loan, so the current portion, the payment I'm making this year, is the current portion of long-term debt, okay? So liability is made up of current liabilities and non-current liabilities. What's the non-current liability? It's long-term debt. What is the current liabilities? Accounts payable, accrued liabilities, current portion of long-term debt. Moving down here to total owner's equity, you can see owner's equity is made up of two items. The first is common stock, and the second item is retained earnings. Retained earnings is the link between the income statement and the balance sheet. So we can see here from 20x1 to 20x2, the retained earnings increased. So 148 minus 115. The difference between 20x1 and 20x2 is 33. And we're going to discuss that later in the income statement. You're going to see that in 20x1, the company had a profit of at least 33 million. It could be higher than that. The net income might have been 40 million, but if it paid some dividends, 7 million, then the retained earnings would be 33. So net income 40 million minus 7 million for dividends, for example. The retained earnings would be 33. Okay, we're going to talk about that later. Nevertheless, you can see again total assets 565, total liabilities 332, plus owner's equity 233 gives us our liabilities and equity. Assets equals liabilities plus equity. Okay. So now we're moving on to Learning Outcome Statement C, which is compare types of assets, liabilities, and equity. And we accomplished a lot of that by looking at the balance sheet for company ABC over 20x1 and 20x2. Anyhow, we can see that in terms of assets, assets are split up between current assets and non-current assets. Current assets are cash, accounts receivable, and inventories, and those are assets that are expected to be converted into cash, used up, or sold within the current operating period, and that's usually 1 year. What is accounts receivable, you may ask? A company sells something and it's on credit, so they would record the sales, but they haven't collected the cash yet, so they would have an accounts receivable. What are inventories? Well, a company buys inventories so that it can be sold. When it's sold, it will be a cost of goods sold, okay? So current assets made up of cash, accounts receivable, and inventories. The next category, as we had mentioned, is non-current assets. It's made up of plant, property, and equipment, PP&E, and that would be at the net book value, subtracting some accumulated depreciation. Other non-current assets are intangible assets, such as patents, as I mentioned. Goodwill and financial assets are considered to be non-current assets. So a little bit more information regarding non-current assets. So when we're looking at when a company purchases a long-term asset, a non-current asset, the purchase amount is capitalized. That means it shows up on the balance sheet and is reported as an asset on the balance sheet. So I'm going to use an example of buying a truck for 100,000 Canadian dollars, and I estimate that I'm going to use that truck for 5 years, and I estimate that after I've used that delivery truck for 5 years, it's going to have no salvage value, okay? So I'm going to show you a little bit of the accounting. Don't worry, you don't have to make any calculations, but it's just important to understand the concept is that when I buy that truck for $100,000, let's say I did that in 2018, it's not an expense for 2018 because I'm going to use that truck for 2018, 2019, 2020, 21, and 22. 1, 2, 3, 4, 5 years, and then at the end of the 2022, I've used that truck a lot. It's maybe going to be worth 0. But anyhow, so when I buy that truck, I'm going to record it as an asset on the balance sheet. But I want to somehow allocate the cost of that asset over the 5 years that I'm going to use it. And how do we do that? We do it through depreciation. So the company allocates the cost of that asset over the asset's estimated useful life, and that's a process called depreciation or amortization for intangible assets. So if you hear the terms depreciation, amortization, it's really the same process, but depreciation is for tangible assets and amortization is for intangibles, okay? So in this example that I'm giving to you, you can see I'm going to use a truck that cost me $100,000, and I'm going to subtract the salvage value, which is 0, and I'm going to divide it by the number of years that the estimated useful life, and I'm going to have $20,000 per year depreciation expense, okay? So each year on my income statement, I'm going to have a depreciation expense of $20,000. But remember, I have an income statement for 2018. I have an income statement for 2019. I have an income statement for 2020, 2021, and 2022. An income statement is for a specific period of time, but a balance sheet is a snapshot as at a particular point in time. And remember, my assets equals my liabilities, and that's as at a specific period of time. So if I wanted to look at that asset, the net book value, after 3 years, for example, well, I know my historical cost is going to be $100,000, but I'm going to subtract 3 years of depreciation, so that my annual depreciation expense would be $20,000 times 3. I would subtract $60,000 in accumulated depreciation, and I know that my net book value of that truck at the end of 2020 is worth $40,000 book value. Okay, and then I could compare that to the market value. The market value may be more or less. Okay, so that's a numerical example of my own. It's not exactly in the text, but it's just putting into numbers the concept that we're talking about, and it's not a difficult concept. It's we buy a truck for $100,000. It's not an expense in the year that we buy it. We're going to use it an estimated useful life for 5 years. No salvage value. 100,000 minus 0 salvage value divided by 5 years gives me a depreciation expense of $20,000 every year on my income statement, and that's going to accumulate on the balance sheet. So on the balance sheet, I'll have the historical value of $100,000 minus the accumulated depreciation. So in my example, I was showing after 3 years, that accumulated depreciation would be $60,000, $20,000 a year for 3 years. Okay, so the amount allocated each year is called the depreciation or amortization expense. It's reported on the income statement. Accumulated depreciation is the sum of the reported depreciation expenses for the particular asset, and the net book value is calculated as the gross value of the asset minus accumulated depreciation or amortization. Okay, so going back to that balance sheet, we saw, I'm just going to pause it here and go back to that balance sheet. We saw here that the gross property, plant, and equipment was $370, and the accumulated depreciation was $120 for 20X1. And we can see that the gross property, plant, and equipment $460 for 20X2. So a couple of things pop out at you. You can see that the company added gross property, plant, and equipment in 20X2 because the number is higher, 460 minus 370. So 460. Now that's, there might be other transactions we don't know, but regardless, we can see at least at gross level, the gross property, plant, and equipment is increased by $90 million. The accumulated depreciation, as we'd expect, would go up from 20X1 to 20X2 from 120 to 160. So we can see that the depreciation expense for 20X2 is very likely 40 million. 160 minus 120, that gives us 40 million. The accumulated depreciation went up by 40 million. That's from the depreciation expense on the 20X2 income statement. So you can see finally that we have the net plant, property, and equipment. 460 minus accumulated depreciation, 300. 370 minus accumulated depreciation, 250. So again, net book value is calculated as the gross value of the asset minus accumulated depreciation. Okay, now we're moving over to the liabilities. Recall the balance sheet, assets equals liabilities plus equity. So we saw that for the assets, it's made up of current assets and non-current assets. Well, similarly, for liabilities, it is broken up between current liabilities and long-term debt. What are current liabilities must be repaid within the next year or operating cycle, which is typically 1 year. And some examples of current liabilities are accounts payable. I've bought something from a vendor, but I haven't paid them yet. So that would be an accounts payable. Short-term borrowings. These are borrowings that I have that must be repaid within the next year. Accrued liabilities, again, an example of an accrued liability would be wages. I've had workers working for me for a week or two. It's not yet payday. I would have a wages payable, okay, an accrued liability. And another category here, current portion of long-term debt. So as we said, liabilities is split up between current liabilities and long-term debt. Long-term debt are debts that are going to be repaid over periods greater than 1 year. And they can be from banks or from other lenders. So a quick example would be a 10-year loan, that's going to be payments over 10 years. So you can see in the current year that I'm in, I'm going to have a payment that is due. So we record that current portion of the long-term debt under a current liability. That would be the 1 year. The other 9 years would show up here as the long-term debt. Okay. So again, just a quick review here, going back to the ABC Company Statement of Financial Position. If we looked in 20X1, under the liabilities section, current liabilities made up of accounts payable, accrued liabilities, proportion of long-term debt. And indeed, you can see, it's the same amount for 20X1 and 20X2. So the long-term debt hasn't yet changed. The current portion of long-term debt is a $10 million payment every year. Okay. Long-term debt, we can see, did grow in 2000X2 by 32 million. So in 20X1, long-term debt was 200, 20X2, 232. So it has grown, but perhaps it was grown at the end of the year and the payment hasn't been made because we didn't see any changes in the payments between 20X1 and 20X2 in terms of the current portion of the long-term debt. Okay. Now on the balance sheet, we're going to look at common shareholders' equity. So again, assets equals liabilities plus equity on the balance sheet or statement of financial position. Assets are made up of current assets and non-current assets. Liabilities are made up of current liabilities and long-term debt. And now we're going to be looking at equity, here referred to as common shareholders' equity. Okay, so shareholders are the residual owners of the company. Remember that assets minus liabilities equals equity. Assets are what we company owns. Liabilities are what the company owes. So if a company sold all of its assets and paid all of its liabilities, what's left over belongs to the common shareholders. They own it. That is the residual. Shareholders are the residual owners of the company. They own the residual value of the company after its liabilities are paid. So the amount of the company's equity is shown on the balance sheet in two parts. Number one is the common stock contributed part, and that is the amount received from selling stock to common shareholders, and these, which are direct contributions by owners when they purchase the shares of stock. The second component here is retained earnings, and retained income or retained earnings represents the company's undistributed income, as opposed to the dividends that represent distributed income. So as I said, in any given year, a company will have a profit, it'll have a net income. It may pay dividends to the common shareholders. What's left over will show up on the balance sheet as additional retained earnings. They're not distributed earnings, they're retained, okay? Retained earnings are an indirect contribution by owners who allow the company to retain profits. Retained earnings represent a link between the company's income statement and the balance sheet in the way that I described, okay? And when a company earns a profit and does not distribute it to shareholders as dividends, the remaining profit adds value to the company's equity. Yes. So retained earnings, again, if we look at it as a box like this, assets equals liabilities plus equity. As the company is profitable, we're adding retained earnings. Therefore, it could show up perhaps on the balance sheet as cash. The balance sheet is growing. As the company is profitable and retaining earnings that are not distributed to the shareholders, we're going to increase our retained earnings. And again, assets equals liabilities plus equity. If E is going up through increased retained earnings, something has to be going up on the A side, perhaps starting with cash, that cash being converted into assets, etc. Okay? Now we're moving on to Learning Outcome Statement D, which is describe information provided by the income statement. And you can see the income statement, revenues minus expenses equals profit. That's the basic equation. And the income statement is sometimes called the statement of profit or loss, profit and loss statement, statement of operations, or P&L for short, okay? And the important thing to note is that recall that the balance sheet was as at a point in time. So for example, December 31st, 20X1, or as at December 31st, 20X2. But the income statement is for the period of time, so it'd be for the year of 20X1 or for the year ending December 31st, 20X2, for example. So now we're looking at the income statement for ABC Company. So you can see it's for the year ending 20X2, so it's just for that 1 year. We can see revenues, and again it's in millions. So revenues were 650 million minus the cost of sales, sometimes cost of goods sold That gives us a gross profit of 200. We don't even really need to bring up the calculator. 650 minus 450, 200. Then we're going to deduct some other operating expenses. What are those operating expenses? Selling expenses, general and admin expenses. And again, here's that depreciation expense that we talked about that we saw on the balance sheet, okay? Showing up as accumulated depreciation. Each year the depreciation expense is added to the balance sheet under the category of accumulated depreciation. So we can see here we've got total other expenses equaling 90. So we have a operating income of 110. Again, revenue minus cost of sales, gross profit minus operating expenses gives us our operating income of 110 million. Below, and sometimes we're going to call that earnings before interest and taxes, because the next line is the interest expense. So when we borrow money, when we have long-term debt, we need to pay interest, and each year we will have an interest expense. So EBIT, earnings before interest and taxes, or operating income, 110 minus 15 in interest expense, and we've got earnings before tax of 95 million, okay? And income tax of 19 million. So we have a net income for 20X2 of 76. But that wasn't the change on the balance sheet in terms of retained earnings. Recall, we said that the retained earnings increased from 20X1 to 20X2 by 33 million. But first of all, we had to look at the income statement. We saw that the net income was 76 million. However, there were dividends paid to the shareholders of 43 million. That's cash money. So again, if I paid a cash dividend, assets equals liabilities plus equity, the cash would go down by 43 million and the retained earnings would go down by 43 million. So 76 million net income minus dividends gives us the retained earnings. The increase that's been retained by the company, not paid out as dividends. So that's the increase in retained earnings in 20X2. So again, just pointing out the link between the income statement and the balance sheet. So now we saw in the income statement, the net income was 76 million. 43 million was paid as dividends. So the amount of net income that was retained was 33. And we can see that that was in 20X2. So the retained earnings, 148 minus the previous year, 115. So we know that the retained earnings for 20X2 was 33 million, and that 76 million in net income minus the 43 million in dividends gives us our 33 million increase in retained earnings in 20X2. Okay, moving on to learning outcome statement D, which is describe information provided by the income statement. So again, we're just going to look in a little bit more detail at the income statement, okay? So you can see here, and I want to show you that I can write this out fairly quickly in my own shorthand. Revenue minus cost of goods sold gives me my gross profit, okay, minus operating expense, just, whatever nomenclature I want, is going to give me my EBIT, my earnings before interest and taxes, or my operating income, minus my I, which is interest, is going to give me my earnings before tax, minus T is going to give me my net income, okay? So it's not too many lines of the, abbreviated consolidated income statement that you really need to understand. Revenue minus cost of sales equals gross profit minus other operating expenses gives me my operating income, or EBIT, minus interest gives me earnings before tax, minus tax gives me my net income. So zooming in here on the cost of sales, what is included in the cost of sales? It's the cost of producing or acquiring the goods or services that are sold by a company. So again, you see cost of sales, or sometimes you see cost of goods sold. So now we're moving down the income statement. Revenue minus cost of goods sold equals gross profit minus other operating expenses. What are making up those other operating expenses? Marketing expenses, admin expenses, again, depreciation, which is a non-cash item, etc. Those are our operating expenses. So again, I'm in the ebook here. Just very quickly, we can see for ABC Company, revenue 650 million, cost of sales 450, gross profit 200, and we can see these other operating expenses: selling expense, general and admin, and that depreciation expense. Total other operating expenses 90. So we have an operating income EBIT of 110, earnings before interest and tax, interest expense 15. So earnings before tax 95, income tax 19. So we have net income of 76 million. We recall that dividends paid to the shareholders was 43 million. And here's some additional information. If I just scroll it up a little bit on the screen, you can see the number of shares outstanding is 50 million. So if we take the net income of 76 million and we divide it by the number of shares outstanding, we'll have a earnings per share. So 76 million divided by 50 million gives us $1.52 earnings per common share. And in this case, the dividend per share would be 86 cents. If we just bring up the calculator, we can see dividend was 43 million in dividends divided by 50 million in common shares. That's 86 cent dividend per share. And again, 76 million in net income divided by 50 million common shares. That's earnings per share of $1.52. So that's a little summary of the other operating expenses: marketing expense, administrative expense, and depreciation expense. So to boost your confidence, I just want to show you a practice question from the learning ecosystem, and this is at the moderate level, and you're going to see that it's not too difficult. The accounting questions in the ecosystem are not too difficult. Don't be scared of the accounting, folks. So the question is, which of the following is an example of an operating expense? A, dividends paid to shareholders; B, interest payments made on a bank loan; or C, depreciation expenses for plant and equipment? I think you'll agree with me that that question is not too difficult. Which of the following is an example of an operating expense? Depreciation expense for plant, prop, and equipment. The previous slide, we can see here other operating expenses made up of marketing expense, administrative expense, and depreciation expense is what we saw for ABC's company. Okay, so just very quickly though, I put in a couple of points here, and by the way, we're going to see a little bit more of this in the cash flow, so we're seeing this as a bit of a preview. Anyhow, dividend payments are not expenses and are not incurred in the operations of the company. Dividend payments are reported as a financing activity on the cash flow statement. So we haven't looked at the cash flow statement, but we're going to see that dividend payments are recorded on the cash flow statement, and they're categorized as a financing activity. In terms of interest payments, interest repayments are reported on the income statement as a financing expense, not as an operating expense. So remember, we had EBIT, earnings before interest and tax, and then we had the interest. So we know this one, in terms of an operating expense, it can't be interest, because operating expense, operating income is EBIT, earnings before interest and tax. So interest is below the operating expense, okay? And it's categorized as a financing activity on the cash flow statement. Also, just because we haven't looked at the cash flow statement, but any payments for inventory is a cash outflow for an operating activity. And the purchase of a machine, we did see that that's a cash outflow related to investing activities. So we haven't looked at the cash flow statement yet, but as I mentioned, it's made up of operating, investing, and financing categories, okay? So moving down the income statement now, we're looking at interest expense. And again, interest expense is when I have long-term debt. There's going to be some interest rate attached to it. I'm going to have an annual interest expense. And then that's going to give me my earnings before tax. And then I'm going to have my tax expense, okay? Earnings before tax minus tax gives me my net income, and net income represents the income that the company has available to retain and reinvest in the company, retained earnings, or to distribute to the owners in the form of dividends, which is a disbursement of profits, okay? So recall from the example, the net income was 76 million, and they paid a dividend of 43 million, and they had the increase in retained earnings was the 33 million, okay? So again, you should be able to, as a basic understanding, just remember that revenue minus cost of sales gives me my gross profit, minus my operating expenses, gives me my operating income, or we're going to call that EBIT, earnings before interest and taxes, minus my interest, gives me my earnings before tax, minus my tax gives me my net income, and my net income, from my net income, I'm going to pay some dividends, and so net income minus dividends is going to give me my retained earnings that carries over from the income statement to the balance sheet, and that's the link between the income statement and the balance sheet is the retained earnings. Okay, so there's one last slide on describing information provided by the income statement, and as I pointed out, I'm going to start from the bottom here. Earnings per share is easy to understand. That's the net income divided by the number of shares. So we already saw that calculation for ABC company. And dividends per share equals the dividends, which is $1. And you can see in this case it's dollars divided by number of shares. So in each case, it's giving us earnings per share or dividends per share. Okay. And this gives us some indications of profit. And so now that we're down to the final thing that we're going to look at with regards to the income statement. And it's something that you may have heard mentioned, EBITDA. Okay. What is this EBITDA? Well, remember that when we saw on the income statement, revenue minus cost of sales gives us our gross profit minus other OPEX, operating expenses, gives us our EBIT, earnings before interest and taxes, minus our interest gives us our earnings before tax, and then minus our taxes gives us our net income. So you can see how easily I should be able to recall that. Now we're talking about EBITDA. Well, what is this EBITDA? Well, remember in this these other operating expenses was general and admin and depreciation. So what we're doing with EBITDA is we're taking the depreciation from the operating expense and we're adding it to the EBIT. So we have EBITDA. Why are we doing that? Because recall, depreciation is a non-cash item. So when we look at EBITDA, it offers us a closer approximation of the operating cash flow than the EBIT, because the EBIT, earnings before interest and taxes, includes a non-cash item in the item of depreciation expense. So if I add the depreciation expense to EBIT, I get EBITDA, and that is a closer approximation of operating cash flow, and that's why you may have heard the term EBITDA several times. We're taking the depreciation from the operating expense, adding it to EBIT, because depreciation is a non-cash item. So just to be clear on that EBITDA calculation, I've got the income statement up for ABC Company for 20X2, and we can see the operating income is 110 million, and that's earnings before interest and tax, because the very next item is interest. So how do we calculate the EBITDA? Well, we'd start with the EBIT, which is 110, and we'd add back the DA, which is the depreciation expense of 40. So for ABC Company for 20X2, its EBITDA would be 150, okay, which is higher than the earnings before interest and tax, or the operating income. And we're doing that to more closely perhaps approximate the cash earnings, operating cash, because you can see that the income statement is including a non-cash item, depreciation expense. Okay, so that is just finishing off the earnings before interest and tax, depreciation and amortization, EBITDA. Learning outcome statement E is distinguish between profit and net cash flow. So we can see ABC Company had a net profit of 76 million, okay, but that doesn't necessarily match the cash flow for the year 20X2. The income statement shows a company's profit, but profit is not the same as net cash flow. That is how much cash the company generated during the period. The income statement indicates how good a company is at creating profit, but is also critical to see how good the company is at generating cash. Profits are measured on an accrual basis, which means that revenues are recorded when the revenues are earned rather than when they are received in cash. That's why we see accounts receivable on the balance sheet. And the related expenses may be recognized before or after they're paid out in cash. We can see that there's current liabilities, accounts payable. So because of the timing difference between when revenues are earned and when customers pay their bills, the cash received during a particular period is not likely to be the same amount as the revenues earned during that period unless all sales are for cash. So equally, the cash paid for expenses during the period is not likely to be paid at the same amount as the expenses recognized on the income statement. Thus, profits and net cash flow are typically not the same amount. The balance sheet reports long-term assets when they are acquired, but there is no long-term asset expense shown immediately on the income statement. Instead, the use of a long-term asset is expensed on the income statement over its useful life by using a depreciation expense, which we've already gone through. So a company must eventually generate profits to provide returns to shareholders, but it must generate cash to keep itself going because suppliers, employees, expenses, and debts must be paid for the company to continue operating. So a company can be profitable but have negative cash flows. For example, if it is slow at collecting cash from a customer or growing rapidly. So that's a key point that can be tested, is that a company can be profitable but have negative cash flows if it's slow at collecting cash, okay, or growing rapidly. So a company may operate at a loss but have positive cash flows. For example, if the company has a very high depreciation and amortization expense. So a company can operate at a loss as long as the owners allow it, provided the company can generate cash flows to support its survival. But a company cannot survive long with negative cash flows, no matter how profitable it seems to be. So now we're moving on to learning outcome statement F, which is describe information provided by the cash flow statement. So first we looked at the balance sheet, then we looked at the income statement, and now we're looking at the cash flow statement, okay? So recall, we mentioned that the cash flow statement is split up into three categories. One is cash flow from operating activities. Number two is cash flow from investment activities. And number three is cash from financing activities. We're going to discuss these in a little bit more detail. But before we get to that, I just wanted to point out that what are we looking at? We're looking at the change in the company's cash balance. So if I bring up the balance sheet for ABC Company again, we can see that in 20X1, the company had cash of $16 million, and as at December 31st, 2000X2, ABC Company had $25 million in cash. So if I bring up the calculator, you don't even really have to bring up the calculator. I can see that's 9, but 25 minus 16, the cash grew on the balance sheet by $9 million. But we want further explanation of how that increase in $9 million happened, and where do we get that information? We get it from the cash flow statement, which gives us the sources and uses of cash, and it categorizes it into three different categories. Okay. So if we look at operating activities, that's usually recurring activities on an ongoing basis. So cash from operating activities, we saw those cash expenses, accounts receivable is cash coming in, accounts payable is cash going out. Those are the day-to-day operating activities and the cash flows associated with that. Now be very careful, because it says cash from investment activities. Investment sounds like stocks and bonds, but when we're talking about the cash flow statement for accounting, investing activities is talking about buying new equipment or selling old equipment. So we're investing in equipment, okay? So just be careful with a little bit of language, because when we're talking about selling new stock or repaying loans, stocks and bonds, we're actually talking about cash from financing activities, okay? So in contrast to operating activities, investing activities and financing activities may not recur. A company may not be selling new stock every year, so there may not be, or issuing long-term debts, a small company, so there may not be recurring financing activities every year, okay? Similarly, a small company may not be investing in new equipment every year, okay? But in general, on average, of course, you're going to have operating cash flows on an ongoing basis, okay? Thus, knowing how the company generates cash by recurring activities or non-recurring events is really important understanding for estimating a company's future cash flows. Okay, so on the left-hand side here, I've got the cash flow statement open for ABC Company. And on the right-hand side, I've got the balance sheet open, because the cash flow statement actually refers to several items on the balance sheet. So I just want to have the two open for you side by side. Okay, what I don't have open is the income statement. You can see here that the cash flow statement actually starts with net income, and then we add back the depreciation expense, because that's a non-cash item. So I have it set up with the cash flow statement and the balance sheet, but I didn't open the income statement. Nevertheless, the cash flow statement starts with net income, operating activities net income. We add back the depreciation expense. And again, we're talking about operating activities. So what are some of the operating activities? Well, it's selling and collecting accounts receivables, buying inventory and selling it, accounts payable, etc. So we can see here, with regards to the operating activities, we start with net income, add back the depreciation expense, and then we look, accounts receivable increase from 20X1 to 20X2. So that's a use of cash. we had sales, but we didn't collect the cash. Our accounts receivable have increased, so that's a use of cash, and that's why that's a negative number right there. So 76 net income plus the depreciation expense minus the increase in accounts receivable. If accounts receivable went down, that would be a positive number, okay? Next thing, we're going to look at the inventories. Inventories increased. That's a use of cash. I buy inventories perhaps using cash. So inventories has increased from 90 to 95. That's a use of cash. Inventories has increased, so that's a -5. Again, if inventories had gone down from 90 to 85, that would be a positive number. Then on my operating activities, I'm also going to look at not only the current asset side, I'm looking at the current liabilities. We can see, again, accounts payable went from 50 to 54. That's an increase. That means I bought something, but I didn't yet pay for it, okay? So that's an increase in payables is a positive for cash, okay? An increase on current assets is a use of cash, it's negative, or a decrease in current assets is going to be a positive, okay? Similarly, if my accounts payable went down, then that would be a negative number, okay? Because my accounts payable went down, I used cash, it would be a negative number. Anyhow, that's how, don't worry, there's no calculations on the exam. The questions are all fairly easy to understand, but you just want to be able to understand the mechanics of a cash flow statement. We start with net income. From the income statement, we add back the depreciation, and then we're looking at some changes in the operating accounts on the balance sheet, and that's where we get the numbers from, okay? This is called the indirect method of building up the cash flow statement. The next category is really easy to understand. It's the investment activities, and with regards to the investment activities, you can see here that we're looking at the plant, property, and equipment. And as I mentioned, plant, property, and equipment went from 370 to 460 from 370. So if I just bring up the calculator here and move it into appropriate space, just one second. Okay, we can see plant, property, and equipment on the gross, 460 in 20X2 minus 370. And that is a change of 90. So we can see our PP&E grew by 90. So that's, of course, that's a use of cash. It was an investment activity of 90. So that's an easy one to understand, okay? Next is cash from financing. So we're going to be looking down here at sort of our long-term debt and equity section. And the first thing that we'll do, just to make it really easy, is we can see that there was no cash from shares. So the cash inflows from new shares is 0. There is no new shares being sold, okay? But however, if we look here at the long-term debt, we can see that the long-term debt in 20X2 is reported at 232 million. In 20X1, it was at 200 million. So our long-term debt grew by 32 million, and that is cash into us, so that would be a positive, okay? And also, we know that the dividends paid to shareholders was 43 million, and that's a financing activity. Okay, so again, you can see here then there's the, we're doing some subtotals. So operating activities, 76 plus 40 minus 5 plus 4. It gives us net cash flow from operating activities, 110. The net cash used in investing activities was the negative 90. And then our net cash from financing activities, we did more borrowing, but we paid the 43 million in dividends, so that was a negative 9. So the net increase or decrease in cash, well, that was a positive. Let's just bring up the calculator here and move it over to the right-hand side a little bit. So you can see, just starting from the top, 76 million plus the 40 million minus the 5 million minus the 5 million plus the 4 million. You can see our net cash from operating activities, 110. The negative 90 was easy, minus 90. And then our net cash from financing was a negative 11, so we subtract the 11. And so you can see our net increase or decrease was 9, and we add that to our beginning cash at the beginning of the year. The end of 20X1 is the beginning of 20X2, and we get our ending cash of 25, which we see on the balance sheet, okay? So you can see here, there's our 16 million at the end of 20X1, which is the beginning of 20X2. That's our 16 million. Our increase in cash was 9 million. Where did that 9 million come from? We had positive net cash from operating activities of 110, but we spent 90 on new equipment. and we had a net cash flow of negative 11 from financing. So that was a increase in cash during the year of 9 million. We add that to the 16 million that we had on the balance sheet, and finally we get our 25 million. So that's the point of the cash flow statement, is that when we look at cash on the balance sheet here, the 25 million and the change, the 9 million, we want to know where did that come from. And we want that categorized into operating activities, investment activities, and financing activities. Now that might be a little bit quick for you if it's your first time tackling some accounting, but I'll tell you it's not all that difficult. Again, the cash flow statement, we start with our net income from the income statement, we add back depreciation, and then we look at some of the changes in the balance sheet accounts. And these balance sheet accounts need to be categorized as either operating, investing, or financing activities. So accounts receivable was categorized as operating, inventories was operating, there was no change on this item. Plant, property, and equipment is categorized as a financing activity. There was no change in any intangibles there. Accounts payable is an operating activity. Accrued liabilities, there was no change, and there was no change in the current portion of long-term debt. And then, of course, we get into our financing activities. Long-term debt is a financing activity, which did change. Common stock is a financing activity. And dividends, which aren't showing up here, but it's the change in the retained earnings. So it's net income minus dividends gives us our retained earnings, okay? And you can see the change in the retained earnings. So we can calculate the dividends paid was 43 million, okay? That gives us our net increase or decrease in cash plus the beginning cash. We get to our 25 million. So the 25 million has been explained. Okay, the last section on cash flow is 8 minutes, and I know that's long. It's really above and beyond the call of duty, what's required for the CFA Institute Investment Foundations program. But I just want to make sure that I gave the full and comprehensive explanation of how that cash flow statement was put together, starting with the net incomes, and looking at the changes in the balance sheet. And it's not that difficult, but I just want, so I'm coming here. The next thing that I'm going to show is just a practice question, which is at the expert level. And just to remind you, there's no calculations that you need to make on the exam. That was a lot of nice to know information, not need to know. So here's an example of a practice question from the learning ecosystem, which is at the expert level. And you'll see, really, it's not all that difficult. So to understand the changes in a company's long-term assets over the year, an investor would review the company's A, cash flow statement, B, statement of operations, or C, statement of financial position. Okay, I hope you agree with me that this expert question is not all that difficult. To understand the changes in a company's long-term assets over the year, the investor would review the cash flow statement. So changes in the company's long-term assets are found in the investing section of the cash flow statement. We saw that for ABC Company. They invested 90 million in new plant, property, and equipment, okay? Now, the only thing you might have thought is statement of operations, that's the income statement. That shows the depreciation expense, but it's not showing any information about purchases or dispositions during the year, maybe unless there was gains or losses on the disposition. Now, the only thing is you may have thought, wait a minute, I went through that cash flow, I went through the balance sheet and I could see changes in the balance sheet from year to year. And from that, I could glean that there was an increase in long-term assets. But be careful here, because to understand changes in the company's long-term assets, C says the statement of financial position. It's not saying statements. It's not giving us 2 years. So if you looked at only 1 year, you wouldn't know the company's changes in the company over the year. The balance sheet is only showing the assets as at that certain day. It's showing the snapshot. Okay, with 2 years, yes, you can do some analysis and look at the notes to the statements. But if you're just looking at the statement of financial position or the balance sheet, you will not see the changes over the year, okay? The statement of financial position is only the single point in time. So that's the one thing. Maybe some people might have thought, oh, long-term assets, that's on the balance sheet, I'm going to look at C. No, changes over the year. The cash flow statement is for the year. The income statement is for the year. The balance sheet as at a specific day. Not too difficult. Learning outcome statement H is explain links between the income statement, balance sheet, and cash flow statement. Okay? So although each major financial statement, the income statement, balance sheet, and cash flow statement, offer different types of financial information, they're not entirely separate. For example, the income statement is linked to the balance sheet. through net income and retained earnings. In the case of ABC Company, the net income of $76 million, shown on the income statement, and the starting point of the cash flow statement, is separated into dividends paid to shareholders of $43 million, which is an outflow of cash on the cash flow statement, and an increase in retained earnings of $33 million, shown as an increase in retained earnings on the balance sheet between the end of 2000X1 and the end of 2000X2. The income statement is linked to the balance sheet because the income statement's revenues and expenses that have not been settled in cash are reflected on the balance sheet as current assets or current liabilities. In other words, the revenues not yet collected are reflected in accounts receivable, and the expenses not yet paid are reflected in accounts payable and accrued liabilities. Another example is when a company purchases fixed assets, such as equipment or building. These cash expenditures are shown as an increase in the gross fixed assets on the balance sheet. That was $90 million we saw in 20X2 for ABC Company, and a cash outflow on the cash flow statement. But they only show up on the income statement when the cost of the fixed asset is depreciated over time. So as noted earlier, depreciation is a non-cash expense representing the annual expense for the fixed assets. The balance sheet reflects financial conditions at a certain point in time, and it usually includes at least 2 years so that we can do the comparisons. The income statement and cash flow statements explain what happened between those points. So we could see, we looked at the balance sheet for 20X1, 20X2, but the income statement and cash flow statements for the year of 20X2, okay? Thus, the 3 financial statements show different kinds of information, and each has a different purpose, but they are related. Just a quick slide on retained earnings. So just to emphasize, the income statement is for a period, say a calendar year. So we saw that for ABC Company, the income statement was for 20X2. Therefore, the income statement gets reset to 0 at the beginning of the following year. For 20X3, there's no revenues yet. There's no expenses. So then at the end of the year, it gets what's called closed out. It gets reset back to 0. But if there's a net income, positive net income or loss, that has to be transferred over to the balance sheet. We do that by closing out the income statement and transferring the balance to the balance sheet. And the balance sheet account is retained earnings. And retained earnings is therefore the link between the balance sheet and the income statement. Balance sheet accounts carry balances from year to year. We see that with property, plant, and equipment, cash. You've got cash in 2000X2. You've got cash in 20X3, 20X1. We saw that. So balance sheet accounts carry balances from year to year, and therefore the balance sheet accounts are as at a certain date. Usually, we could see in the examples for December 31st. And the final point to note is that dividends are paid out of retained earnings. A company has positive net income. It's going to distribute some of that income as dividends to the shareholders. That's a disbursement of cash, which goes out, and therefore that would reduce the retained earnings. Learning outcome statement I is explain the usefulness of ratio analysis for financial statements. Okay, so financial statement analysis involves the use of information provided by financial statements and other sources to identify critical relationships. These relationships may not be observable by simply reading the financial statements. The use of ratios allows analysts to standardize financial information and provides a context for making meaningful comparisons. In particular, investors can compare companies of different sizes as well as the performance of the same company at different times. Okay? So ratios help managers of the company or outside creditors and investors answer the following questions. Number 1, how liquid is the company, which is the short-term ability to pay bills? Number 2, is the company generating enough profit from its assets? Number 3 is how is the company financing its assets? And finally, number 4, is the company providing sufficient return for its shareholders? So you can see as we move on to the next learning outcome statement, J, it's going to be identify and interpret ratios used to analyze a company's liquidity, profitability, financing, shareholder return, and shareholder value. So I just put that into the slide here because when we look at this question with regards to how liquid is the company, short-term ability to pay bills, though we call those liquidity ratios. If we look at ratios regarding profitability, we call those profitability ratios. How is the company financing assets? We look at some financial ratios. And then finally, is the company providing sufficient returns for its shareholders? We look at some shareholder return and shareholder value ratios. Now, the important thing to understand in the CFA Institute Investment Foundations program, you have to understand these ratios. There's a numerator and denominator. That's what a ratio is. It's a one number divided by another. But in the learning ecosystem, you're not required to do any calculations. Okay, you need to understand the ratios, the different categories: liquidity, profitability, financial, shareholder return, and value. For each, they give you a couple of different examples. It's not full comprehensive by any means, but there's 2 or 3 ratios for each category, and you have to understand, what is the you have to understand why it's useful, and to identify and interpret the ratios a little bit. Are things getting better or are things getting worse based on the ratio? Okay. So moving on now to Learning Outcome Statement J, which is identify, interpret ratios used to analyze a company's liquidity, profitability, financing, shareholder return, and shareholder value. So we're starting with the liquidity ratios. And recall that liquidity ratios are answering the question, how liquid is the company? And it's the short-term ability to pay bills. Okay, so there are 2 ratios that we're going to look at. The first one is the current ratio. And as I mentioned, a ratio is just one number divided by another. The formula for the current ratio is current assets divided by current liabilities. So one of the things that I put here in bold color is that when you're looking at different ratios, you want to know where is the information coming from. So you can see the numerator, current assets, is from the balance sheet, and the current liabilities is also from the balance sheet. So with regards to ABC Company, the current assets for 20X2 was 165. The current liabilities was 100. So 165 divided by 100 gives us 1.65, okay? So it says here, liquidity ratios measure a company's ability to meet its short-term obligations. A current ratio of 2 is frequently used as a minimum desirable standard. We call that a rule of thumb. So if we were going to look at ABC's current ratio for 20X2, and we see that it's less than, say, an industry average of 2, we would have some concerns because the current ratio is less than the industry average, for example. Or if we looked at the previous year and the number was lower than the previous year, again, that's a comparison that we do. It's called horizontal comparison because we're looking from year to year. We would look at the trend. Is the number getting worse or getting better? Okay. So the second ratio with regards to liquidity is the quick ratio. And the quick ratio, the denominator is the same. We're dividing by current liabilities. The numerator, it's current assets minus inventories, okay? So we started with the 165 current assets, but we're subtracting out the inventories. Now, why would we want to do that? Because if we're looking at a company's ability to pay bills, if they needed to come up with cash fairly quickly, well, we know sometimes inventories are obsolete. Sometimes inventories may have been on the balance sheet for a long time. We don't know what's in those inventories. Could they be converted to cash? There might be an issue. So to be more conservative, we would use the quick ratio, and we would simply deduct the inventories from the current assets, divided by the current liabilities. And of course, the number is going to be always lower because our numerator is going down, okay? So to just finish with the current ratio and the quick ratio, I just wanted to show you the balance sheet for ABC Company and to highlight where that information is coming from. So the current ratio, current assets divided by current liabilities for 20X2, there it is, 165 divided by 100. That gives me 1.65. For the quick ratio, we're going to deduct the inventories, so 165 minus the 95 divided by 100, and that gave us the quick ratio. Okay, so again, as I said, we could do a comparison to the previous year. So if I bring up my calculator in here and highlight 20x1, the current ratio for 20x1, current assets of 146 divided by current liabilities of 96, we can see that we have 1.52, okay? So 1.52 is less than 1.65. So in fact, the current ratio has gotten better for ABC Company, but if we use a rule of thumb of 2, or if we were given an industry average of 2, see, there's data, there's interpretation, and there's evaluation. The data is the ratio. It just gives us the number. But then we need to interpret it and evaluate it. So our evaluation would be, well, the current ratio has gotten better from 20x1 to 20x2, from 1.52 to 1.65, so that's a positive. However, comparing it to, say, an industry average or a rule of thumb is 2, our evaluation is that it is not as good as the industry average, and so we'd want to keep an eye on that current ratio, because it's indicating the company's ability to pay its short-term bills. So now we're moving on to the profitability ratios, and recall the question that we want to answer with by using profitability ratios: is the company generating enough profit from its assets? Okay, so I've split this into 2 slides, and I wanted to show you when we first look at profitability, some profitability ratios, we're looking again at income statement to income statement. Numerators from the income statement, denominator is from the income statement, and the ratio that you need to know for the CFA Institute Investment Foundations program is the net profit margin, and that's net income divided by revenue, and that's going to give you, the answer is going to be in terms of a percentage. Okay, but I just wanted to point out that again, we've got the structure for the income statement: revenue minus cost of sales, gross profit minus other operating expenses gives us our operating income, or EBIT, minus interest expense gives us our earnings before tax, minus tax gives us our net income. Okay, well, we could also calculate the gross profit margin by looking at the gross profit divided by revenue. We could look at the operating profit margin by looking at operating income, or EBIT, divided by revenue. Okay, so you can see everything is divided by revenue, percentage of revenue, and that gives us our margins. And we could do earnings before tax as well, earnings before tax margin. Okay, but the ratio that we need to know for this chapter is the net profit margin, which is net income divided by revenue. The answer is in a percentage. Both numbers are coming from the income statement. So when we're looking at profitability ratios for this chapter, there's just 3 ratios. And the first one was the net income margin, which was net income divided by revenue. Okay, so we saw that on the previous slide. But again, the question is saying, is the company generating enough profit from its assets? So therefore, we're going to look at 2 more ratios in this section under profitability. And the second one is the basic earning power, and the numerator is operating income, which we get from the income statement, but it's divided by total assets, because the question is the company generating enough profits from its assets? So the numerator is coming from the income statement, but the denominator is coming from the balance sheet. Okay, so the second formula, basic earning power equals operating income from the income statement divided by total assets, which we're picking up from the balance sheet. And finally, the third ratio that we are looking at on this for this learning outcome statement regarding profitability ratios is return on assets. And that's a fairly easy one. It's net income from the income statement divided by total assets, and that gives us our ROA, return on assets. Okay, so continuing with the profitability ratios, there's 3 ratios that we need to be familiar with. Number 1 is the net profit margin, and we can see that as net income divided by revenues. So we find that all on the income statement. That's an income statement to income statement ratio. Net income for ABC Company for 20X2 was 76, and the revenues were 650. So 76 divided by 650 gives us 0.1169. So it's 11.69%. As I said, these margins are in terms of percentages, okay? The second ratio, the profitability ratio that we need to be familiar with, is ABC's basic earning power. And the formula for the basic earning power is operating income divided by total assets. So we find our operating income from the income statement. However, we find our total assets from the balance sheet. Okay, so this is the ABC's company statement of financial position for 20X2 and the income statement for 20X2. So our operating income is 110 million. We're going to divide that by total assets, 565. It's 0.1947, so 19.47%. The third profitability ratio that we need to be familiar with is return on assets, ROA, and the formula is net income from the income statement. So the numerator is 76 divided by total assets, which is from the balance sheet, 565. So 76 divided by 565, 0.1345, equals 13.45%. So as I mentioned, this is a nice to know, not need to know. We could also calculate the gross profit percentage, and we could calculate the operating income margin. But what we're required to understand for this chapter is the net profit margin, okay? Net income divided by sales. Operating profit margin would be operating income divided by sales. And gross profit margin would be gross profit divided by sales. And therefore, as I mentioned, we can look at that percentage. That's just giving us the data. The interpretation and evaluation would be, is that getting better year to year? Is it getting worse year to year? And how does that compare to the industry or peers? And the reason why that we put it into percentages is that it makes it useful for comparing different companies in the same industry, for example, that are of different sizes, okay? The percentages gives us a basis for comparison. And then we can do our interpretations and evaluations. Okay, we're just going to do a quick practice question from the learning ecosystem. You can see this was considered to be at the expert level, so this should cheer you up. The question is, the basic earning power ratio is calculated as A, net income divided by total assets, B, operating income divided by revenues, or C, operating income divided by total assets. As I said, I think that question should cheer you up. I just want to show you, I've been going through some numbers, we've been doing some calculations, but in terms of the exam, what's considered to be an expert question is just being able to identify the ratio. And so you have to have it memorized. And for profitability ratios, there's only three ratios. Number one is the net profit margin, net income divided by revenues. Number two, return on assets, which is net income divided by total assets. And number three is the basic earning power, which is operating income divided by total assets. So this was just asking you to recall the formula for the basic earning power ratio. And of course, C is correct. It's operating income divided by total assets. The basic earning power ratio is defined as operating income divided by total assets. It measures the profit generated from operations with the assets used to generate that income. So if you look at answer A, net income divided by total assets, no, that was the formula for return on assets. Net income, return, total assets, ROA. And for B, operating income divided by revenues, that's the operating profit margin. As I said, that is not a required formula that we need to know, and that's why I wanted to put it in there, because they did include it as a selection within the learning ecosystem, but that's not one of the formulas that you had to memorize. The three formulas for profitability ratios was net profit margin, ROA, and basic earning power, okay? And so you just had to know the numerator and denominator, have the formula memorized. That's considered to be an expert question. I don't think that's too difficult. I think when you do the 70 questions in the learning ecosystem, you're going to find that they're quite a bit easier than you had hoped for. So nothing to worry about. Now we're moving on to the financing ratios or financial ratios. Recall the question is, how is the company financing its assets. So there are two ratios on this slide. One is the debt to equity ratio, and you can see the numerator is debt and the denominator is equity. The second ratio is ABC's equity multiplier, and this is a measure of financial leverage. You can see the numerator is total assets and the denominator again is equity. Okay, so this is not too bad. The denominator in both cases is equity. Numerator, ABC, debt to equity ratios. Debt to equity, that's easy. Debt in the numerator, equity in the denominator. And the equity multiplier, financial leverage, is assets over equity. Okay, and you can see I've pointed out that these are balance sheet to balance sheet ratios. So you can see here one thing that you need to note, though, with regards to the debt, we have the long-term debt here, 232, but we need to include the current portion of the long-term debt. That's why we have the 232 plus the 10 divided by equity is 233. There's the total owner's equity, 233. So the debt to equity ratio is 1.04. And you can see this is an important point to bring up as well. That's in terms of times, okay? Some of our ratios, as we saw, our profitability margins were percentage, but this ratio, debt to equity, is in terms of times. Same thing with the equity multiplier, that is in terms of times. And total assets divided by equity, here we've got the total assets from the balance sheet, 565, divided by equity, 233, and that equals 2.42, and that is times. It's not a percentage, okay? So a common accounting ratio used for assessing leverage, which is the extent to which debt is used in the financing of the business, is the debt to equity ratio. This ratio measures how much debt the company has relative to equity. Assets equals liabilities plus equity, you recall. So we want to look at the amount of debt relative to the equity. Typically, the debt considered is only interest-bearing debt, including short-term borrowing, the portion of long-term debt due within the reporting period, and long-term debt. It does not include accounts payable and accrued expenses. The equity multiplier measures the amount of total assets supported by one monetary unit of equity. The greater the assets' values are relative to equity, the more debt is being used as financing. A company with a low financial leverage or equity multiplier is one predominantly financed by equity. A debt to equity ratio close to 1 indicates that the debt and equity provide approximately equal amounts of financing. An equity multiplier close to 2 shows that the asset value is more than twice the amount of equity. Having a higher proportion of debt is riskier because a company is obligated to service its debt, pay interest, but does not have a similar obligation to service its equity or to pay dividends. So a quick practice question from the learning ecosystem, and again, this one's at the expert level. A company has an equity multiplier of 1.5 in an industry which has the average equity multiplier is 2.0. Compared with the industry, the company A is less solvent, B uses a lower portion of equity financing to finance its assets, or C uses a higher portion of equity financing to finance its assets. Okay, the correct answer is C. This is an expert question, but I think if we work our way through it, you'll see that it's not too difficult. So a company has an equity multiplier of 1.5 in an industry with average equity multiplier is 2.0. Compared with the industry, the company uses a higher portion of equity financing to finance its assets. So C is correct. The equity multiplier or financial leverage ratio equals total assets divided by equity. That's the formula for the ratio. The lower the number, the more the assets are financed by equity. Therefore, because the company's ratio of 1.5 is lower than the industry's ratio of 2.0, the company uses a higher portion of equity financing to finance its assets than the industry does. So this is a nice to know, not a need to know, but one of my study tips is sometimes I work it out using an example, and I'll use multiples of ones or tens or hundreds or thousands, and I'll make up my own example and I'll work through the math, and a lot of cases that'll help me understand. So here I just used a base of 100 for my equity, okay? So the formula is assets divided by equity. So an equity multiplier of 1.5 using a base of 100 for my equity, that means I would make the numerator 150. My total assets would be 150. Then recalling the formula assets equals liabilities plus equity, if my assets is 150 and my equity is 100, means the liabilities has to be 50. Then if I do my equity divided by my assets, 100 divided by 150, you can see the ratio is 66%. Then if I move over here to the equity multiplier of 2.0, then you can see using again the same denominator of 100 for my equity, the numerator would have to be 200 to give me the multiplier of 2.0. So in this case, my assets would be 200, more assets. So assets equals liabilities plus equity, equity remaining at 100, the same, means my liabilities would be 100. Therefore, my equity divided by my assets, 100 divided by 200, it's 50%. So you can see an equity multiplier of 1.5 means a higher proportion or a higher percentage of my assets are being financed through the equity. So again, that's a nice to know, not a need to know, but I've worked it out as a little example, just using hundreds, 100 for my equity base, and it kind of proves to me that yes, an equity multiplier of 1.5 does mean that 66.6% in using my numerical example of the assets are financed by equity, which is a higher proportion than 50%. So now we're moving on to shareholder return. And the formula that we have here is return on equity, okay? And the ratio is net income divided by equity. Net income we get from the income statement, and equity we get from the balance sheet, okay? So the return on equity, net income divided by equity, 76 million divided by 233 million gives us 0.32618 equals 32.62%, okay? So when we're looking at shareholder return ratio, return on equity is net income divided by equity. That's a fairly easy ratio to understand and interpret. And again, that is in percentages. So now we're moving on to some ratios concerning shareholder value. Market value ratios is management creating shareholder value. So there's two ratios that we're looking at here. The first one is market price per share divided by earnings per share. Gives us a price to earnings ratio. That's a P to E ratio. Price per share divided by earnings per share. Okay, PE ratio. The second one is same numerator. It's the market price per share, but we're dividing by the book value per share. So it's the book value of equity, and that's going to give us a price to book ratio. Okay, so if the PE ratio is higher for one company compared with another company in the same sector, it may indicate that the investors think that the company with the higher PE ratio has stronger growth potential. Alternatively, the stock with the lower PE ratio may be undervalued by the market, potentially. With regards to price to book ratio, the book value of equity reflects the historical costs and essentially measures the amount shareholders have invested in the company through its lifetime. A ratio greater than 1 indicates that investors believe that the company is worth more in the long run than the amount the shareholders have invested in it. In other words, the company's management has created value for shareholders since their original investment. A ratio of less than 1 is an indication that the company's managers have destroyed value. So now that we've learned to calculate or understanding the numerator and denominator, what the ratios are, with regards to liquidity, profitability, financing, shareholder return, shareholder value, this slide is just talking about now interpreting the ratios. And so here we've got a nice little summary of some of the ratios that we've looked at, and I've included the formula here in the column. Then we have ABC's companies 20x2 value, and then we have the industry value, so we're going to do a comparison, okay? So starting with the current ratio, current assets divided by current liabilities, ABC's 20x2 was 1.65 times. Remember, this is in times, not percentage, and that is lower than the industry value. And as we said, the rule of thumb may be 2, so our interpretation would be that that is not as good as the industry, and it's something that we would want to look at and monitor. Moving on to the quick ratio, you can see that The numerator is current assets minus the inventories. So we're just taking out the inventories because they are potentially less liquid, divided by current liabilities. Again, as we would expect, if the current ratio is lower, well, taking out the inventory, again, our quick ratio is lower than the industry. So we have potentially a liquidity concern. But moving on to return on assets, net income divided by assets, the ABC is higher than the industry value. So we would interpret that the company is doing a better job of providing a return, profitability based on the amount of assets. The formula for basic earning power was operating income divided by total assets. So again, the same denominator. And the ratio, and again, these are in percentages, recall. The profitability ratio, the basic earning power, 19.47%, greater than 15%, so better profitability. ROE, return on equity, net income divided by equity, 32.62%, greater than the industry value. Net profit margin is net income divided by revenues, again, higher than the industry. Operating profit margin, operating income divided by revenues, better. And now, again, don't forget, when we're looking at asset turnover and financial leverage, you can see these are ratios that are in terms of times, not as percentages. That's one thing to be aware of. Revenue divided by total assets, and you can see we're lower. So our revenue being generated from the amount of assets that the company has. So that's a concern that we may want to follow up on. The interpretation is the company's not providing enough profitability relative to the assets compared to the industry. And then finally, with the financial leverage, total assets divided by the equity, it's lower, okay, than the industry average. Another quick practice question. You can see this is from the learning ecosystem, and it was considered to be an expert question. Which of the following ratios would be used by an analyst to assess the value being created for shareholders by the company? A, net profit margin, B, current ratio, or C, price earnings ratio? So this question is regarding shareholder value ratios, because you can see, you want to read the questions very carefully. Which of the following ratios would be used to assess the value being created for shareholders? Well, A, net profit margin, that's a profitability ratio. B, current ratio, that's a liquidity ratio. So the correct answer is C. C is correct. To assess the value being created for shareholders, the analyst would use the price earnings ratio, PE. The PE equals market price per share divided by earnings per share. Remember that. That's market price per share divided by earnings per share, okay? And tells the analyst what the market is willing to pay for each $1 of earnings. If the two companies are in the same industry and one has a higher PE, it may indicate that the company with a higher ratio has a stronger growth potential, and therefore that investors are willing to pay more for its earnings. So just a quick thing here, I've put some of the ratios. We're not going to go through them all again, but you just want to remember the categories: liquidity, profitability, financing, shareholder return, and shareholder value. So number one, you have to be familiar with the numerator and denominator, what the formula is for the ratio. And the other thing that I want to point out, remember, is that in terms of a percentage or in terms of a times, and then having, that gives us the data. And then the next thing is, in some cases, to interpret the ratios when we're comparing it year on year or against some industry standards. Okay, so that was an expert question, but again, I don't think that was too difficult. If you get up to speed, a little bit of memorization you need to do with regards to the categories of the ratios and what ratios the CFA Institute Investment Foundation's program is looking at with regards to financial statement analysis. So we're down to the last 3 slides for this video. I know it's been a bit of a long one, but thanks for hanging in there. What we're going to look at now, the final last thing is 3 slides, is the decomposition of return on equity. So recall, return on equity is net income divided by equity. So for ABC company for 20X2, the net income was 76 million, equity was 233 million. So the return on equity was 0.32618, which equals 32.62%. Okay, but by using a little bit of algebra, we can expand the formula. A return on equity can be decomposed into three components: net profit margin, asset turnover, and financial leverage. And then by looking at those three components, and sometimes over time or compared to industry peers, we can sometimes come up with more and better interpretations and evaluations of the company. Okay, so let's just start at the first level. You can see return on equity, net income over equity. So I've split that out to net income over total assets, which is our return on assets. Remember, that's a profitability ratio that we've learned earlier, so that should not be new to you. ABC's return on assets, net income over total assets. Net income was 76 million, total assets was 565 million. So the ROA for our ABC company was 13.45%. We've already seen that. If I multiply the ROA times leverage, this is something new, which is total assets over equity. Total assets was 565 and equity is 233. Those numbers are not new to us, but assets over equity gives us leverage. That gives us 2.429 if I'm rounding to 5 decimals. And you can see I've used a little bit of color coding: net income in blue, equity in gold, and assets in green. Net income over total assets times total assets over equity. If I scratch out the terms for total assets, you can see I'm back to my net income over equity. So all I've done is I've expanded, I've decomposed the ROE at this first level, net income over equity, to ROA times leverage. And so 13.45% times 2.42489, you're getting back to this 32.62% for your return on equity. Okay, so ROE can also equal ROA times leverage, but we're not quite yet because we can see that ROE can be decomposed into three components: net profit margin, asset turnover, and the financial leverage. Well, we've got the financial leverage here. Where do we get the net profit margin and asset turnover? Well, we're going to further decompose that return on asset on the next slide. So now we're doing the decomposition of return on assets. So recall, return on assets, net income divided by total assets. So we've done that. That's a profitability measure. And for ABC company, 76, net income divided by total assets, 565. So we had 13.45%. Again, I've used some color coding here. We can see that we can further decompose return on assets onto net income divided by revenue, which gives us now our net profit margin, times revenue divided by total assets, what we call asset turnover. Okay, so again, by just scratching out the numerator and denominator, you can see we're back to our net income divided by total assets. We've just expanded the formula by using a little bit of algebra. And so we can see net income over revenue. Net income was 76 million. Revenue was 650 million. So again, 650 million. Total assets was 565. That gives us 0.1169 times 1.15 gives us 0.1345, 13.45%, which is the same answer as net income over total assets. So our ROA, we were able to decompose it. ROA, net income over total assets, or net profit margin times asset turnover. So we're down to the last slide now, the decomposition of return on equity. So return on equity, net income over equity for ABC company, 20x2, net income 76 million, equity 233 million. So the ROE was 32.62%. So what did we? So we also said that ROE we can also calculate by return on assets times by leverage, and then return on assets we could further decompose into the net profit margin times the asset turnover. So here we are finally at the last stage. Return on equity can be decomposed into three components: net profit margin, asset turnover, and financial leverage. So again, if we scratch out the revenue to revenue, assets to assets, you can see we're back to net income divided by equity with my color coding. So ROE, net profit margin, 76, net income, 76 million, divided by revenue, 650 million, times revenue over assets, revenue 650 million, total assets 565, times our leverage, which was total assets 565, divided by equity 232. That gives us 0.1169 times 1.15 times 2.42, and that gives us 0.3253, which is 32.53%. You can see it's a little bit different than my 32.62. That's just a little bit of rounding. When you're using 2 decimals versus 5, it's just going to give you a little bit rounding difference. Okay, so that's again, don't be too intimidated by that. You don't need to recreate these calculations at all. You just want to have an understanding that first of all, the formula for return on equity is net income divided by equity, but by doing a little bit of algebra, we can break that into a number of different components, and that gives us some more and perhaps better insights into what's driving that return for the shareholders. Is there more leverage? Is the company using more debt, which would increase the riskiness? Are they more efficient in terms of their asset turnover, or are they driving the ROE through better and higher net profit margins? So again, we can do some comparisons over time. We can do some comparisons within the industry. Okay, so a very long video with regards to accounting, but hopefully you've got a better understanding of accounting if you've never studied accounting before. And that is the conclusion for this video, which was Module 3, Inputs and Tools, Chapter 7, Financial Statements for the CFA Institute Investment Foundations. I know it was a bit of a long video, but thank you very much.